Cooperative Development Board. At the outset, I thank the Chairman of Cooperative Development Board, CMA, Central Council member Navneet Kumar Jain, for giving me an opportunity to share my perspectives on this very important topic for the cooperatives, how to achieve enhanced performance, better performance, improved performance by using the concept and techniques of budgetary control. Good afternoon and welcome everyone. So cooperatives are unique organizations because these organizations are formed by association of persons who come together with a common purpose. They pool their resources for mutual economic and social benefit. India has had a long history of cooperative movement in the country, and which has really contributed to not only economic development of the country, but also in building up community and corporate relationships. A cooperative organization is created by its members, and the cooperative belongs to them. It is managed by the members themselves, and the members have all the right to participate in the decision-making process of the cooperative. That's the basic idea behind a cooperative. Members, when creating the cooperative, seek to achieve and acquire the best possible optimum results from the functioning of the enterprise. The common objective of establishment of a cooperative is that members seek to obtain a service or employment which will generate income for them and become a source of sustenance for them going forward. The smooth functioning of a cooperative depends to a large extent on various factors, such as the initiative taken by the members themselves in various activities, laying down an action plan, and actually implementing the plan at the ground level are the basic requisites for effective and smooth functioning of a cooperative. The budget of cooperative is one of the important components essential for its functioning and for its existence, because it lays down the path through which a cooperative is going to function and also achieve its given objectives within a given time frame. The budget for a cooperative is almost similar to the budget of any other organization, but of course it has some of its own specialities, peculiarities, and particularities. Budgeting process for the cooperatives helps and involves the strategic allocation of financial resources to different activities and different facets of the functioning of cooperative organizations with a view to achieving the goals of the cooperative organization effectively. The key challenges faced by the cooperatives are that the functioning of cooperative organizations is often hampered by inadequate financial responsibility, ineffective internal management, budgeting, and record keeping, which results in less productivity, wasted efforts, squandered resources, and ultimately suboptimal outcomes. These are key essential characteristics of cooperative organizations: inadequate financial responsibility, ineffective internal management, budgeting, record keeping, which results in wasted efforts, squandered resources, and below par and subpar outcomes. But we should always remember that financial stability and financial sustainability is key to financial sustainability is key to survival of an organization because it leads to long-term survival and effectiveness of the organization. And financial sustainability is all about laying down the plans for the organization, both for the long term, medium term, and the short term, and making sure that adequate resources are available for fulfilling and achievement of those plans. And that is what leads to long-term survival and effectiveness of any organization, including a cooperative. The challenge, however, for all organizations, especially the cooperatives, is how to achieve their goals of financial sustainability, which ultimately depends upon ability of the organization to be able to effectively manage the cash flows. That's the crux. How to ensure that a company is able to achieve, a cooperative is able to achieve its objectives, but at the same time maintain financial sustainability for ensuring long-term survival, existence, and effective performance in the marketplace. And that ultimately depends upon effectiveness with which the company is able to manage its resources, especially the cash and the liquidity aspect regarding the company's performance. So budgeting is all about identifying allocation of funds and also identifying intended expenditure, and then ultimately deciding how exactly and for what different purposes the expenditure is going to be incurred with a view to achieving the organizational objectives. Budgets are important as they provide the estimates of future revenues likely to be generated by an organization and the expenditure likely to be spent, likely to be incurred by the organization for the achievement of its objectives and for coordinated management approach towards achievement of the corporate objectives. Budgetary control helps in better planning of the company's operations, and it also considers how to deal with future potential risks and opportunities by putting in place an efficient system of control. That's very important. Once a company has a robust, comprehensive system of budgetary control, it enables the company to identify future potential risks as well as opportunities by putting in place an efficient system of controls. The budget procedure empowers supervisors to work under given working conditions, and it also facilitates anticipation and actualization of required changes in the functioning of the organization. That is the key to budgeting. Budgeting is important for every organization, and more particularly for the cooperatives, because budgets are nothing but basically future plans and forecasts. It enables a company to evaluate the financial viability of a chosen strategy or a chosen action path, and effective budgeting plays a very, very significant role in ultimately ensuring due expected performance of the businesses. If the company doesn't have an effective budgetary control system, it will be difficult to monitor the performance of the company through various stages, and thus it also becomes difficult to be able to monitor the effectiveness of companies' plans and forecasts in achieving the given corporate objectives. Budgets provide useful information to evaluate performance of any company, and it also helps in appropriate financial allocation strategies across various components of the organization. Evaluation of firm's performance depends upon preset targets, which should be realistic, both in physical as well as in financial terms. And these targets and the performance of the company against these targets ultimately leads to appropriate financial allocations, allocation of resources for meeting these various targets by way of implementation of strategies across various components and departments of any organization. Through effective budgeting, one can predict the future expenses and costs and can accordingly enforce effective control by working towards expected revenues, and it ultimately helps to realize the required level of financial sustainability for an organization. Budgets are important for all types of organizations, more particularly for the cooperatives. That's because the cooperatives generally have to do with limited resources, and thus it is imperative that these resources are put to most optimal and the best possible use. And that is ensured, supported, and facilitated by an effective budgetary control system monitored and managed by an organization. Budgets are important for all kinds of organizations. Companies use budgets for guidance and control of their operations, with the ultimate objective of optimum utilization of resources. If a company doesn't have a budget and it just goes on spending money on different activities in pursuit of its objectives, the end result may not be very, very optimum. End result may not be very productive. Once the company has a roadmap, which is provided by the budgets, it provides the requisite guidance and control on the operations of the company with the ultimate objective and aim of optimum prudent utilization of scarce available resources. Every organization faces the challenge of scarce, limited resources which are required to be deployed for achievement of the given objectives of any organization. There's no point starting up your operations without having a game plan or without having a budget in position, because budget actually provides the required guidance and control of the various operations of any company for proper, prudent utilization of resources. An effective budget helps in aligning plans. It also executes the process in a more effective manner, and a budget also helps in tracking implementation of and the functioning of the various activities of the organization, with a view to always keeping track as to whether the company is able to achieve its given objectives or not. And therefore, the budgeting helps in successfully monitoring the goals and objectives of any organization, especially a cooperative, which is a joint effort of all the members of the cooperatives. It is very essential that the functioning of cooperatives is effective in terms of achievement of the prior set goals and objectives. Budgets provide an overview of the various activities planned by cooperatives, and it also keeps track of the spending pattern and the utilization of financial resources in the achievement of the laid down objectives by performance of various activities by a cooperative organization. So, once the objectives of the organization are laid out, then we need to work out what are the different activities which are required to be carried out with a view to achieving the given objectives of an organization. And then we also need to identify requirement of funds and allocate the requisite resources to those particular activities so as to be able to achieve the given objectives of any cooperative. And that's where budgeting plays a very, very key and important role. Budget process involves repetitive actions of planning and management of the process, leading to guided information about the expected real outcome from the activities of any organization. A budget is a very important planning as well as a control device, because by laying down a budget at the outset and then using the budget and leveraging budget for monitoring the different activities in different phases of the operations of an organization, we get information about the expected real outcomes towards the achievement of the organizational objectives. Budget is both a planning and a control device. It is used as a planning device to lay down the different activities which are required to be performed by an organization and the different resources which are required to be allocated for completion of those activities and those sub-activities. And thereafter, once the budget has been set, it is used for the purposes of monitoring and control of the activities of an organization from time to time by comparing actual performance vis-a-vis the budgeted amounts allocated for each activity and each sub-activity, and that's where the check and balance system is brought into application by using and leveraging the effective mechanism and architecture of budgeting. Budgeting is useful and vital for all kinds of organizations, and it is especially critical and important for cooperatives because cooperatives are specialized organizations They have their own peculiar characteristics. They depend upon the joint contribution made by the members and joint activities performed by the members of the cooperative, and therefore the resources are required to be managed in a very, very effective manner, in a very, very prudent manner, and that's where budgeting helps in achieving the given objectives of a cooperative. Once a cooperative organization has an effective and robust budgetary control system, it's going to ensure proper tracking of all expenditures incurred by the company towards different activities, because it will provide to you information about the amount spent as well as the performance of the organization and the outcome of that expenditure, which is also tracked by an effective budgetary control system maintained by an organization. So what are the different common types of budgets that we have? First of all, let us recapitulate that budgeting is an essential step or aspect of financial planning. It helps in financial planning and financial control. But the first step is that as part of the financial planning, once you have a budget identified for a particular activity or for a particular organization, it helps you to keep track of your expenditure and also the performance vis-a-vis, and thus it helps you to track and monitor performance of the organization right across different time horizons and different stages in the completion of a given project. So therefore, budgeting is both a financial planning as well as a financial control technique. The key advantage of having an effective budget is that a budget helps you to allocate resources efficiently. Resources are very, very scarce, and thus they need to be optimally utilized and optimally allocated towards different activities of any organization. And budgeting helps you to do just that only. Allocate resources efficiently towards different activities and functions of an organization, thus improving your chances of achieving the organizational objectives within the given constraints of the resources that the organization has. Budgets also help to improve the efficiency of the businesses and organizations, because we are always going to keep track of input-output ratio, what is the amount spent and what is the performance arising out of that expenditure incurred by the organization. Because we're going to have a comparative study of both of these two aspects at all times continuously, it ultimately leads to efficient functioning of the organization, and it helps in efficient allocation of resources. A budget is both a planning and a control device. Once you have a budget with you, you can use the budget for monitoring and control of your expenditure, monitoring and control of your cost from time to time through different stages of the functioning of organization, and therefore, end of the day, a budget helps you to control your costs. And a budget also prepares you for handling future emerging scenarios. Future is uncertain. Things may not work out the way you intended them to be. But if you have a budget which takes into account the possible future scenarios, then probably there would be an inbuilt mechanism by which your operations of organization would automatically get adjusted to the current emerging business future environment, and thus the organization will be able to function more effectively and more successfully. There are different types of budgets which are prepared by organizations. We have operating budget, capital budget, cash budget, master budget, static budget, flexible budget. Each type of budget serves a unique purpose. In a structured organization, all these different types of budgets are prepared with a view to enforcing and ensuring effective planning and control of the different activities of the organization. These bouquet of budgets, all these budgets collectively help in effective financial management of a business and thus ensure long-term success and sustainability of any organization. Because you're starting off your activities by having a budget in place right in the beginning, it will ensure that all the resources of the company are effectively utilized. It will also help you to get efficiency in operations. It will help you to enforce control on your different costs, and it will also enable you to carry out your functioning of the organization under different future scenarios. That's the advantage of having a budget right in the beginning. Each type of budget will serve a unique purpose, and all these bouquet of budgets, all these different types of budgets ultimately contribute to effective financial management of a business, ensuring its long-term success and sustainability in the marketplace. Some of the common types of budgets are operating budget, which covers day-to-day activities of the organization. Operating income and operating expenditure are mashed together while preparing an operating budget, and it helps you to enforce effective control and track performance of the company with regard to its day-to-day function. A capital budget is prepared and used for investment planning, planning for investment in plant and machinery, land and building, etc., made by a company, is facilitated through and by the use of capital budget methodology. Cash budget tracks incoming and outgoing cash to ensure liquidity. There are two primary objectives of every organization. The organization must be liquid at all times. Liquidity should not be a concern, should not be a problem for a company. And secondly, the organization must also be profitable. The liquidity aspect is controlled and monitored by preparation of a cash budget by the company, which tracks incoming and outgoing cash, inflow and outflow of cash, and that helps you to monitor the level of cash available with the company at all times, thus ensuring that the company never gets into any kind of a liquidity problem or a liquidity trap. A master budget is a comprehensive budget that includes all the different other types of budgets. You prepare raw material budget, manpower budget, sales budget, purchase budget, operating budget, cash budget, capital budget. End of the day, you consolidate all these budgets into one single document, and that's what is called a master budget, which is nothing but a comprehensive budget that includes and encompasses all the other budgets being utilized by the organization for effective planning and control of its operations. Distinction is also made at times between two different types of budgets, static budget and a flexible budget. A static budget, also called a fixed budget, is prepared for a defined specific level of activity for a business. If you think that your organization is likely to operate at 80% capacity during the year, then you may look at 80% capacity level activities of the company and prepare a budget at that particular level, and that's what is called a static budget or a fixed budget, which is fixed for a particular level of activity anticipated by an organization for a year. On the other hand, a flexible budget is one which is designed to change with changes in the level of activity actually achieved by an organization. It is more useful. A flexible budget is prepared not only for one fixed level of activity anticipated by organization to be achieved, but it is actually prepared for range of level of activity. 60%, 70%, 80%. It may be prepared for these three different levels depending upon at what level the organization actually functions. You can use the numbers of that particular column to monitor and track performance of the organization depending upon what is the actual level of capacity utilization, level of activity actually utilized by the organization during a given period of budget period. So there are different types of budgets which serve different purpose for any cooperative organizations. Operating budget looks at controlling day-to-day revenue and expenses. Capital budget helps you to plan for investments in land and building, plant and machinery. Cash flow budget helps you in tracking inflow and outflow of cash to ensure liquidity. A master budget is all-encompassing, comprehensive budget, which includes all the other budgets of the organization. A static budget or a fixed budget is one which is prepared for a defined level of activity for an organization, and a flexible budget is prepared for different levels of activities of the organization as anticipated during a particular given period of time. In this presentation today, we're going to cover in detail some of the key budgets which are prepared by cooperative organizations. We're going to talk about operating budget. We're also going to talk about cash budget, then move on to capital budget, then look at sales budget, and then also talk about and discuss the techniques of budgeting, including zero-based budgeting and performance budgeting. What is an operating budget? An operating budget is a detailed projection of what a company expects its revenues and expenses to be over a period of time. A budget is a plan of action for a given period of time. Normally it is prepared for 1 year, even though in the case of cash budget, we prepare cash budget for 1 year, but we subsequently break it down into quarters, into months, into weeks, so as to have a very, very minute, detailed, comprehensive, effective control on the cash inflows and cash outflows. All the other budgets other than cash flow budget are normally prepared for an annual basis. Companies formulate an operating budget near the end of the previous year or at the beginning of the new financial year by estimating and anticipating the likely level of activities of the company during the following year, and then converting those activities into sub-activities and thus assigning monetary values to each activity entailing revenue generation or entailing expenditure on the part of the organization. By monetizing each activity and each sub-activity of the organization, we are able to draw a budget which should generally be done right in the beginning of the year so that you can use it for the purposes of planning and control and effective tracking of, monitoring of the activities of organization throughout the year. Operating budget helps organizations to set business goals, the key objectives for a particular year, It's a both planning and control device. It's a planning device in a sense that it sets the basic goals of organization for a given year. And then by leveraging budget, by using the budget for monitoring and tracking, it helps you to achieve those business goals. And thus, to that extent, we can say that budgeting is both a planning and a control device. Every month, every quarter, managers of cooperatives compare actual results with the operating budget, analyze the deviations, if any, both negative and positive, identify the reasons for those deviations, and then they start asking questions to themselves whether sales of the organization are more or less as compared to projected sales. What is the expenses level of the organization? Are the expenses more or less? Or we had prepared the budget maybe 7 months back. Now, after 7 months, there may have been some changes in the external environment or the internal operating environment of the organization. You also got to ask a question to yourself. Do I need to recast some of the figures of budget? Do I need to readjust some of the numbers in my budget because the situation has changed over the period of last about 6 or 7 months? And then the budgets will also help you to analyze the performance of organization. Budgets enable the organization to adapt to changing conditions so that you can modify your actions and strategy and thus achieve the given objectives of better performance, optimal performance for any organization within a given time frame. Operating budget, as the term signifies, is the budget concerned with monitoring and tracking of the different operations of the organization. So you will have both revenue numbers and expense numbers in the operating budget because it's basically going to help you track and monitor the performance of organization across its different dimensions, across its different activities throughout the year, month on a month, quarter on quarter, throughout the year is going to provide you information to what extent the organization is able to meet and achieve the basic objectives for which the organization was set up. So what are the components or parts of an operating budget? An operating budget includes both revenue and expense components. Of course, the more detailed an operating budget is, it will become more useful and valuable for a planning and control device for the organization. An operating budget will also include a high-level summary along with several supporting sub-budgets, providing greater details into some of the key activities. For example, operating budget will have a subset as sales budget, and sales budget would then also be broken down not only quarter-wise, but also geography-wise and maybe also customer-wise. Customer-wise, geography-wise, product-wise, quarter-wise, breaking down of the sales budget provides you huge useful information with a view to tracking the revenue profile of your cooperative during a given year. Similarly, you can have a sub-budget purchase budget. For different types of materials, you can have different purchase budgets, which all get consolidated in a comprehensive master purchase budget, which provides you complete details of all the various sources, purchases that the company is going to make during the year with a view to supporting and supplementing its various activities. Some of the common components of operating budget are revenues. This includes all the different ways a company makes profit, not exactly profit, but actually earns revenue by selling goods or services. Projected revenue is nothing but year-on-year forecast. What do you think is going to be level at which the company will generate sales during a coming period. First quarter of the year, second quarter, third quarter, fourth quarter. Most of the companies have seasonal fluctuations. The sales of all organizations practically do not remain the same quarter on quarter. They vary and they fluctuate depending upon change in season and because of change in quarter, depending upon the product and also the market conditions. So by breaking down revenue on a quarter on quarter basis, breaking down revenue on a product portfolio basis, breaking down revenue as per the customer segments, ultimately provides you huge insights as to what drives revenue for the organization. What is that activity that actually provides and generates revenue for the organization is driven basically by the customer segments, the product portfolio, and also the timing quarter on quarter, month on month. Volume is driven by, it is measured in terms of number of units, and volume of any cooperative organization is driven by what kind of products the company is selling, what is the product portfolio, how many different products you have in your portfolio, what do you think is going to be expected, anticipated sales of different kinds of products being sold by the company, and ultimately attaching a number to them so as to convert them in terms of expected revenue. Similarly, you also have to have a fix on your customer profile. Who are going to be your customers? How many customers do you expect to be able to generate revenue for you during a given period of time? That also will generate the number required by you for the purpose of arriving at the volume. Every company decides to sell a product at a given selling price. So you need to identify a per unit selling price. The selling price of the same product may vary from category to category. Same product can have different prices in different geographies. Same product can be sold at discount depending upon differences in timing, differences in customer groups. And this is the data which you will require for generating your revenue numbers, your volume, expected volume, and also the expected price at which you're going to be able to sell the product in the marketplace. Then coming down to variable costs. What is going to be the likely level of cost of goods sold, expense incurred on direct selling, sales commission, payment processing fee to be paid to bankers, freight, logistics cost, certain other aspects of cost connected with marketing and direct labor. These are going to be variable cost components of your operating budget. Similarly, you've also got to look at fixed cost, expenses which remain constant irrespective of the level of activity actually achieved or attained by an organization. They are required to be paid, they are required to be incurred, whatever be the level of sales, whether up or down. You have rent of the office, rent of godown, you have corporate office expenses, you have insurance, you have communication expenses, you have management salaries, and you have utilities. All these are primarily of the nature of fixed costs because these costs remain fixed irrespective of the level of sales or level of activity actually achieved by a cooperative organization during a given period of time. Just to make it clear as to what is not included in an operating budget. An operating budget will not include capital expenditures. Capital expenditure is one which is incurred for acquisition of capital assets, land and building, plant and machinery, furniture and fixture, because we normally prepare a separate CapEx budget, capital expenditure budget. We're going to talk about that subsequently in this presentation. Therefore, that's not part of the operating budget per se. Debt payments, principal amount that you got to pay for the amount borrowed by the organization is also not part of the operating budget. Even though the debt servicing, that means debt servicing will include an EMI, an installment which is required to be paid out, which will have two components. One is the interest component and second is the principal amount getting repaid. The interest part of the debt service obligation is definitely part of your operating budget, but not the principal payment. Operating budget does not include non-cash expenses like depreciation and amortization. Operating budget does not include one-time irregular costs or extraordinary expenses, which are typically not periodically incurred, but these may be just one-off kind of expenses. These are also not included in the regular operating budget. And any income or loss arising out of sale or purchase of investment is also not part of the operating budget. So you will have noticed that operating budget primarily covers and focuses on regular recurring activities that drive the core business operations of an organization, which allows you to get a clear picture of the company's day-to-day financial performance, but things like principal repayment, non-cash expenses, irregular costs, capital expenditure are not included as part of the operating budget in any organization. How do you create an operating budget? Creating an operating budget is a collaborative effort. It's a joint effort involving executives and managers across different hierarchical structures. All of them must come together, work as a team, and then estimate the likely revenue and the likely expenditure to be incurred by an organization during a given period of time based upon the plan that they have for the year, which is called the annual action plan. What do you think is you're going to do during a year? Convert that first in terms of a write-up and then put numbers on different activities being planned to be carried out under that annual plan. And that's what ultimately gives you an operating budget for a given period of time. You also got to carefully consider and note while preparing the operating budget, the changing trends in industry and sector. The world is changing very, very rapidly and significantly. You got to carefully watch the trends. How is the market moving? How is the customer behavior moving? How are the prices of raw material moving in the marketplace? And thus make adjustments in your operating budget accordingly. You must carefully watch the level of competition existing in the marketplace and make due adjustments in your operating budget, even for those competitive situations. If your organization is planning to launch some new products during the year, you must also plan for new product launch, and therefore that also must be duly accounted for in your operating budget. What are the competitors doing in the marketplace? You always got to keep track of that because you have to manage and monitor the activities not only of your company, but also that of your competitors with a view to staying afloat and also with a view to remaining competitive in the marketplace. Changes taking place in sales pattern due to changes in seasons and other activities must also be properly monitored. And you also got to look at what is the overall economic outlook in the country, not only within the country, but also at the global level, because today, because of globalization, every company needs to look at and focus on the world economy, and therefore you must carefully consider and look at the trends and changes taking place in the world economy as well as the national economy. After having done this basic homework, managers then must estimate projected revenue and projected expenses for each part of the organization, each function of the organization, each activity and department of the organization. For example, HR budget may include recruitment expenses, changing benefit costs, the cost of replacing the department's aging laptops, and many other items which are part of the HR budget. The CFO, the Chief Financial Officer of the company, and other executives would be in a best position to provide estimate of projected expenses for the entire company, which along with the revenue estimates will then be built into and incorporated into the operating budget prepared by a given cooperative organization. So, general process for preparing an operating budget for a cooperative society. You first will go for a review of your last year's performance. What has been the income, expenses, the cash flows, understand the trends and patterns, review the last year's performance, then identify your plan of action for the current year, identify what are the different sources of income that you have, what are the likely expenses that you must incur with a view to achieving the given objectives during a given financial year. Every year, a cooperative must also allocate some money towards its reserves with a view to building financial sustainability to meet unexpected expenses and losses. And thus, you must also decide what is that amount that you would like to allocate towards reserves during a particular year. And you must also keep a track of the likely changes in the inflation levels prevailing in the marketplace. And to that extent, due adjustment will also have to be made in the budget prepared by your corporation. And you must set realistic goals. Don't only put numbers based upon projection, based upon mathematical formula or mathematical modeling. Be realistic. Set realistic goals for the cooperative society's income and expenses. Ensure that your budget is balanced. Ensure that your budget's income exceeds your budget's expenses. You must set realistic goals. Moving on to the next important budget for the cooperatives is the cash budget. You know, every company looks for profitability, but at the same time, it is equally important for every organization, including a cooperative organization, to be able to maintain and sustain its liquidity. And liquidity is what is connected with the cash inflow and the cash outflow. And there are two important aspects to that. With regard to cash inflow and cash outflows, over a period of time, we are concerned with the quantum, how much cash inflow, how much cash outflow is likely to happen during a particular period of time. And the second important aspect to look at is the timing. When are you likely to incur a huge cash outflow? At that point of time, you must have adequate cash available with a view to meeting that extra expenditure, which may be a cash outflow likely to happen in a particular month, in a particular quarter. And that's where a cash budget helps you to plan your cash inflows and outflows in such a manner that you are always able to maintain your liquidity. You're never out of cash. You're never illiquid so far as the operations of the company are concerned. Cash budget is prepared with the help of budgeted cash sales numbers, which directly get plotted in your cash budget. You also got to look at your credit sales numbers, because end of the day, even the money from the credit sales is going to be collected. The only difference is it may get collected after a particular period of time, depending upon how many number of days of credit the company would have allowed. End of the day, both cash sales and credit sales numbers are required to be plugged and put into cash budget. The company then needs to analyze what are the different expenses likely to be incurred during a particular period of time, including salaries, purchases, selling and distribution expenses, property tax, GST, income tax, overhead expenses, details of CapEx, capital expenditure, and details of administration expenses, and also the planned distribution of dividend to the members of cooperative organization is also required to be considered while working out estimate of the cash budget of a company. The cash inflows typically start with the opening cash balance as at the beginning of a particular month or beginning of a particular year or beginning of a particular quarter. And then we add on to that likely cash receipts to be generated from cash sales month on a month, quarter by quarter. Then also amount likely to be collected from the customers to who the company will sell the goods on credit basis. Depending upon the credit period allowed by the company, actual realization may happen after 15 days, 30 days, 45 days, but end of the day, the money is going to get collected. Sale of assets and the revenue to be realized therefrom. Sale from investments, income from investments by way of interest income, dividend income, membership fee to be collected from the members of cooperative organization, and grants, if any, becoming available to cooperative organization from any agency, including government, are all going to be part of your cash inflow. Cash outflow or use of fund is going to include all the money that you need or required to repay various liabilities, various loans, amount that you intend to give as loan to your members, amount that you would like to use or would get utilized for refund of members who may have decided to withdraw their membership from the cooperative, the amount of funds that are likely to be utilized for investments to be made by a cooperative organization, how much amount do you think is going to be utilized for payment of dividend, distribution of dividend to the various members? And after taking into account all these various cash outflows and the cash inflows as we had looked at in the previous slide, you'll be able to work out the cash available during the year, which should normally ideally be higher than the cash likely to be spent by the cooperative during a year. The annual figures of cash budget should normally be broken into quarters and further down into months, and maybe even further down as part of your micromanagement on a weekly basis, so that you can have very, very effective monitoring and control on your cash inflows and cash outflows. General guidelines for budget forecasting. Budget is a very, very useful planning and control device. But the usefulness of budget depends upon how carefully the budget forecast has been prepared, how realistic is the budget forecast, then only it will serve its useful purpose. Otherwise, it will only become a theoretical, impractical exercise. The budget should be created with the help of data, which should be realistic, which should be robust, which should be broken down into different categories of incomes and expenditure, and which should then get plotted in different columns. You may leverage Excel formulas to calculate totals of each category and also to calculate the overall balance of the budget. With a view to supplementing the numbers as available in the budget in the form of numbers simply, you can also support them by way of creating charts. To visualize the data, you can use bar charts, pie charts, so that you can better understand the trends and patterns in the cooperative society's financial performance. But the challenge is how to forecast future performance. That's where you first got to focus on what is the annual plan that the cooperative has. Also take into account the inflation, the likely changes in costs and expenses, likely changes in government policy, likely changes in government structure and government regulations. All these factors must be taken into account while preparing your forecast of future performance. And budget will become very, very useful once it is utilized for the purpose of continuous review and monitoring from time to time. And that's where regular review An updation of budget will ensure that the budget remains relevant at all times. Once the budget is compiled by set of executives and managers, then it must got approved from the society's management and members at the annual general meeting. Then the budget should be used for the purpose of monitoring progress of society's financial performance throughout the financial year, making adjustments in budget as and when required during the year. You must be very, very transparent. Your budget must be very, very transparent, and it must clearly outline and provide information with regard to society's income, expenses, and reserves. And for preparation of budget, you must follow the participative approach, involve your members in the budget making process. You must update your budget regularly. You must monitor your cash flow from time to time, and that will enforce and help you achieve effective budgetary control. Budget is both a planning and a control device. When you set up a budget for the future course of action, that's a plan. And thereafter, when you start tracking your budget, monitoring your budget, that's where you are exercising control. Budgetary control involves comparing your budgeted amounts with actual figures, identifying the differences, identifying whether the difference is favorable, unfavorable, analyzing the reasons for those deviations, and taking corrective action so as to avoid those deviations, especially unfavorable deviation during the subsequent period of time. So the budgetary control mechanism or budgetary control system is a very, very active architecture of continuous monitoring of the physical performance as well as monetary performance of the company from month to month, quarter to quarter, and it really helps the organization to achieve its organizational objectives more effectively. Comparison between the budgeted figures and the actual data is called variance analysis. Management should get reasons for unfavorable differences on every item of income and expenditure. That's where the budgeting helps you to apply effective control on various activities of the organization. The analysis of differences as above and the reasons for especially the unfavorable differences should then be presented and discussed in the society's management committee meeting. The management committee meeting then should decide how to address the negative situation and how to convert the negative situation into a positive situation. Capital budgeting is all about budgeting of capital assets of the company. This is all about taking decisions which involve investments in terms of purchase of a new machinery, creating additional capacities, setting up of a new factory, make or purchase of new products. All these decisions are very much part of the overall domain of capital budgeting. Capital budgets and operational budgets serve different purposes in a business. Capital budgets help you to focus on long-term investments, which ultimately go to increase the company's growth potential. Capital expenditure benefits the company over a long period of time. On the other hand, operational budgets cover day-to-day activities and day-to-day income and expenses of the organization. It is therefore concerned with company's regular operations and is usually set for a short-term period, typically just about a year, maybe even less than that. But actually, both operational budgets and capital budgets are crucial. Both have their own importance, both have their own utility, and both the types of budgets are crucial for effective financial management of any cooperative organization. Capital budgeting decisions are long-term investment decisions. Whether to purchase a machinery, whether to construct a new factory building or office building, whether to plan and control and allocate investment funds, long-term investment funds, whether to commit funds for long-term assets. All these decisions are part of the capital budgeting decisions of the organization. Following are the features of capital budgeting. You are spending funds now. When you set up a new project, you're going to spend the funds now, but the benefits are going to arise in future. So the exchange of current funds happens for future benefits in the case of capital budgeting. And the funds are invested and utilized in acquisition and construction of long-term assets. The future benefits to the company arising out of capital expenditure will be available to the company over a number of years in the future. So a capital budgeting process involves identifying a project to be taken up by a company, launch of a new factory, purchase of a new machinery. Then you got to evaluate the project. Then you got to select a particular project, whether it is feasible, not feasible. And then you got to execute that project, actually start implementing, establish that project going forward. These are 4 basic steps involved in the capital budgeting process: project identification, project evaluation, project selection, and project execution. What are the common techniques of assessing feasibility of capital projects? First, and the simple method is to look at the payback period method. Every investment that you make today is likely to generate some income, some return for you in future. So a simple concept of payback period method is to look at within how many years is your investment going to come back to you. Within how many years, entire amount of money that you're going to invest in a project now, today, is going to be returned by way of income generated by the same project. How many years is that going to take? That's called the payback period. So the payback period is the time period over which the company will be able to recover its entire investment into a particular project or a particular machine. But the key drawback of this particular method is that payback period method does not take into account the time value of money, which is very critical. Going forward, because of the inflation prevailing in the marketplace, the value of money is decreasing day by day, year after year. But in the payback period method, normally we don't tend to look at the current value of money. We don't look at the time value of money. That's one of the key disadvantage of using a payback period method, but otherwise, practically speaking, very useful to look at within how many years is your investment going to come back to you arising out of returns from the same project. So if you have 2 projects, one project involving outflow of 42,000, another project 45,000, we can check out based upon the expected cash flow, operating cash inflow profile, how many years, how many months is it going to take with a view to be able to recover the original initial investment or outflow of cash. The second key method of capital budgeting, especially for the cooperatives, is the average or accounting rate of return, which is calculated by dividing average income by the average investment, multiplied by 100 if you want to get the answer in terms of percentage. But the main disadvantage of this method is that it ignores the time value of money, and it also does not take into account the length of the life of the projects. But nonetheless, a very useful method similar to ROI, return on investment, that we normally compute for different projects. We are able to work out what is the average rate of return likely to be generated from this particular project once it gets started, implemented in the marketplace. And that's the real usefulness of using accounting rate of return method for project evaluation. Net present value method, NPV method, is widely used for evaluating capital investment deposits. This is where we use the concept of time value of money. You are going to get the returns from a given project over a period of time, And because of the persistent inflation prevailing in the marketplace and the time value of money concept, you got to work out what is the real feasibility, what is the real return that you're likely to get by making investment in a project or in a machine by using the concept of net present value. So the net present value method is what that compares present values of cash inflows to the original investment. If the difference between them is positive, that means if the cash inflows are more as compared to the original investment, then the project is acceptable. Otherwise, the project is not acceptable from financial perspective. So when you look at the cash outflows, you include the cost of machine, transportation, installation expenses, also add a component of working capital to arrive at the total cost of the project. When you look at the cash inflows to be generated over a period of time by making this investment, then you start with revenue, less expenses, then you get profit before depreciation and tax. Deducting depreciation, we get profit before tax. Taking out tax, we get profit after tax. And then because we are looking at cash inflow and depreciation is hello, hello.
Yes, sir.
Am I there?
Yes, sir.
Am I
Yes.
audible?
Yes,
Thank
sir.
you. Thank you. Thank you. Then we calculate internal rate of return, which is defined as the rate at which the net present value of the investment becomes zero. That means over a period of time, the total returns generated by a project, when discounted at an appropriate discount rate, would become equal to the original investment. The time period over which it happens is what is known as the internal rate of return. This method is based on the basic concept of time value of money, and it tries to arrive at a rate of return at which the funds invested in the project could be repaid out of the cash inflows generated by the project itself. It is called internal rate because it depends on the cash outlay and the proceeds associated with the project, and not at any arbitrary rate determined outside of the investments. Next technique that we use is the profitability index, which is the ratio of the present value of future cash benefits generated by a project at the required rate of return to the initial cash outflow of the investment. What is the overall present value of benefits generated by a given project divided by the net present value of the investment made in the project is what is calculated by using the concept of profitability index. Sometimes we also use the concept of discounted payback period, where we try to find out within how many years is the investment made by the company going to come back by way of returns generated by the same project, but instead of using the data on undiscounted basis, we actually discount the data and then try to arrive at how many years it's going to take for the project to be able to return its original investment after discounting the cash inflows at an appropriate discount. So the capital budgeting techniques that we have discussed are really useful for the cooperative organizations, especially from the perspective of capital allocation and project planning, because it involves consideration of risks in the long-term investments. When you make huge investments in big projects, these are irreversible. You can't get out of them very easily. Once you have decided to get into a project, you are committed for a long time. You want to stay in that project for a long time. You can't make a mistake there. And that's where capital budgeting technique help you to prepare for investment in huge projects, which are going to be long-term and which are also going to generate returns for the organizations over a long period of time. Capital budgeting is an essential tool for financial managers. It helps you to analyze different projects in terms of their viability to be taken up for investments. It also helps you to identify the risk and uncertainty involved in different projects that the company is considering. And capital budgeting provides to the management an effective control on the cost of CapEx, capital expenditure projects. Because ultimately, the fate of a business is decided on how exactly optimally the available resources of the company are used by the organization. What are some of the other types of budgets which are prepared by cooperative organizations? You prepare a sales budget, which helps the cooperative organizations to estimate their sales for a future period. You prepare a production budget, also known as manufacturing budget. Production budget focuses on determining the quantity of a company's product that it wants to produce during a period of time, and also the different categories of products, different types of products, and their volumes. Some organizations also prepare labor budget to determine how much amount is likely to be spent on labor to achieve a certain level of production. It allows the businesses to determine the required workforce and the composition, how many skilled, unskilled, or semi-skilled workers are required to be deployed to achieve the given goals of any organization. Another important budget is the sales budget prepared by cooperative organizations. Sales budget is the projected amount of units the company anticipates to sell in a given period of time and the expected revenue it can earn by selling those many number of units. Typically, sales budget is prepared for yearly basis, then it is broken down into quarterly and monthly segments. When predicting a sales budget or preparing a sales budget, companies normally consider factors such as the previous sales pattern, the seasonal changes impacting the business of the company, activities of the competitors, and the current and expected economic conditions prevailing in the marketplace. All these are important factors in determining and preparing the sales budget for a company. The key elements of sales budget are, first of all, you start with the broad macro sales forecast. How many number of units you're likely to sell during a given period of time, say a month or a quarter or a year. Obviously, you will have to first look at your past data and then create a sales forecast based on the past data, but also keeping into view the current emerging trends in the marketplace. This will provide you data from where you can then cull out number of units that the company expects to sell during a particular budget period. The sales forecast can look at the amount that the company anticipates to sell to an individual, or from a team perspective, or from the perspective of the overall company. Actually, it's a bottom-up approach that we normally follow with a view to preparing a sales forecast. You ask each sales team to prepare their own estimate numbers and then consolidate them, and that becomes your overall sales forecast for the company as a whole. One of the key elements of your sales forecast or sales budget is going to be the price per unit. At what price you're going to sell your product during a particular budget period. For each particular item, a company may be a multi-liner. It may be selling very, very different types of products at the same time, but you got to identify and work out your selling price per unit for different types of products manufactured and sold by the company. If you anticipate the prices to fluctuate during the year, which normally is the case with practically every organization, you can't have a fixed price of the product throughout the year. The prices vary from time to time, period to period, month to month. All that data will need to be factored into while looking at the price per unit while preparing the sales budget. Multiplying the number of units likely to be sold with the selling price per unit at different points of time, you'll be able to work out your total revenue, which is an important part of your sales budget. Total revenue is the company's sales budget. Why sales budget is important? Sales budget is important because it helps the businesses to estimate their overall performance and provide them information as to how much revenue that they are likely to make during a particular period of time. A sales budget also serves as a planning tool for organization so as to set specific targets for their achievement. Sales managers use sales budgets to determine corrective actions to be taken so as to make the sales function more efficient. Sales budget helps in improving cash flow management. It helps to build actionable strategies to reach the goals set by the sales budget. It also helps you to determine the level of overheads of the company. It also helps you to streamline the business processes of the company. Therefore, sales budget is a very, very important document. How to develop a sales budget? Obviously, you first got to decide and identify a particular period of time for which you want to develop a sales budget. Normally, it is prepared for a year and then broken down quarter-wise and maybe even broken down month-wise, maybe even broken down further week-wise. And then you have to gather sales prices. What are the likely selling prices of your products in different months during the coming year? Because those prices are then required to be multiplied with anticipated number of units likely to be sold with a view to arrive at the sales revenue, which is part of the sales budget. And then you have to estimate what is likely to be the sales level in different periods of time during the forthcoming year. The sales numbers, number of units likely to be sold, may be broken down quarter-wise, month-wise, fortnight-wise, week-wise, maybe even day-wise, and then multiplied by the selling price per unit will give you the total sales revenue that the company expects to generate during a particular period of time. While preparing your sales budget, you also have to look at industry market trends. How is the market doing? You may expect to sell a good number of units, but if the market is not supporting you, that may become a difficult target. You always have to keep yourself in sync with the industry market trends, and that requires you to carry out quite a lot of research as to what is happening in the marketplace. And for that, you also need to communicate with your customers. Find out what are their likely purchase plans. How many units are they likely to purchase in a given period of time? Based upon that, you can do your own production planning and then thereafter your sales planning, and then you create your own forecast. Once you have your sales forecast or the sales budget, then as and when actual sales happen, materialize in the marketplace, then you got to compare your actual performance with the budgeted sales performance with a view to finding out how your actual results were in comparison to the estimate that you had prepared right in the beginning. This will help you to take effective measures in the future periods with a view to getting back to your target of achieving the sales numbers which you have planned for a given particular year. Zero-based budgeting is a concept where we prepare budget for a cooperative organization by taking time T0 as the base. Don't look at your past numbers. Start on a clean slate. Look at your business activities likely to happen, materialize in the forthcoming period. And based upon that anticipation, you prepare your budget with base taken as 0. Don't take your last year numbers and then do plus minus 5%, 10%, 15%. You start on a fresh slate using your basic numbers of your estimate of likely level of activity of the company during a particular period of time. And that's the whole concept behind the zero-based budgeting. Zero-based budgeting is a budgeting process that allocates funding based on program efficiency and necessity rather than budget history. Just because you have spent so many thousands of rupees, so many lakhs of rupees last year, add 10% to that, and that becomes your budget number for the current year. That's not a good practice. Look at reality. Look at your realistic activity plan. What is that you intend to do during a particular coming year? And based upon that, all your budget numbers should be worked out. That's the whole philosophy behind the whole concept of zero-based budgeting. We can also look at a performance budget. A performance budget is one that reflects both the input of resources and the output of services for each unit of an organization. End of the day, every organization looks at its performance. It wants to evaluate its performance. And how do you do that? You do that by way of comparison of input of resources and the output of services or products generated by an organization. The goal is to identify some target by way of performance budget. And in a view to, or with a view to achieving that target, you also set your targets of efficiency, expenditure for achieving those particular objectives. And thus you start building up a matrix, building up a whole framework, architecture of performance monitoring system. A performance budget is nothing more than a performance monitoring system which helps you to keep track of your activities, your movements, and your performance during a particular period of time by continuously looking at numbers which you had prepared right in the beginning, comparing that with your actual performance, and then monitoring your performance over a period of time by using and leveraging the whole concept of performance budget. That's where I close my presentation on budgeting as a concept to be used for cooperative organizations for effective tracking of expenditure and also for monitoring of their various performance parameters. In case there are any questions, I'll be pleased to answer a few questions. Thank you so much.
Thank you so much, sir, for such a valuable and knowledgeable session today. And thank you to all the participants for joining us today. And before winding up, I would like to wish you all a very happy Diwali.
Thank you. Thank you. Happy Diwali to all. Thank you.